Welcome back. This is Dr. Annette Moultrie, and we are continuing in Accounting 102. In this video, we will cover Chapter 10, which deals with plant assets, natural resources, and intangibles.
But before we proceed with the video, I need you to click on the subscribe button. Click on the thumbs up button below. Also, click on the notification bell so you'll be notified of upcoming videos.
We are continuing our series in Accounting 102 on plant assets, natural resources, and intangibles. This is part 3. We're starting with the learning objective 10.3. Journalize entries and disposables of plant assets. Eventually, an asset wears out or becomes obsolete. The business can discard the plant asset, sell the plant asset, or they can exchange the plant asset for another plant asset. Plant asset remain on the business's books until they are disposed of. Now, if an asset is still useful, the company may continue using it even though no additional depreciation is recorded. If the asset is no longer useful, it is disposed of. Now, this requires the business to remove the asset and associated accumulated depreciation from the books. In addition, a gain or loss might be recognized by the company. Regardless of the type of disposal, there are 4 steps. 1, bring the depreciation up to date. 2, remove the old disposed of asset and associated accumulated depreciation from the books. 3, record the value of any cash received or paid in the disposal of the asset. And 4, determine the amount of any gain or loss. Gain or loss is determined by comparing the cash received and the market value of any other assets received with the book value of the asset disposed of. Discarding the plant asset involves disposing of the asset for no cash. Here you see in this example, on July 1st, Smart Touch Learning discards equipment with a cost of $10,000 and accumulated depreciation of $10,000. In other words, the asset is fully depreciated. There is no cash involved in this transaction that you see. To dispose of the equipment, the company, Smart Touch Learning, will need to credit the asset account, which is equipment, and debit accumulated depreciation equipment for the $10,000. On July 1st, Smart Touch Learning discards equipment with a cost of $10,000 and accumulated depreciation of $10,000. After the disposal, the equipment and accumulated depreciation equipment accounts have a 0 balance. You see the T account here. You have equipment, a debit of $10,000, credit of $10,000 on July 1st, and the ending balance is 0. Here, the other T account, you see the accumulated depreciation account with a debit of $10,000 and a credit of $10,000. And here, there's a 0 balance. In the second example, Smart Touch Learning discards equipment that costs $10,000. Unlike in the previous example, the asset is not ready or not already fully depreciated. Now, because the asset sold in the middle of the year, which was July, we must compute and record a half year's depreciation before recording the asset's disposal. The asset already had $8,000 accumulated depreciation, and there was no cash involved in this transaction. In this situation, there is $1,500 lost due to the difference between the asset book value, $1,500, and the market value, which was zero, okay? So you have the market value of assets received less the book value of asset disposed of. So the cost was $10,000 less the accumulated depreciation, which was $8,000 plus the $500, which gives you $8,500. So you have a what? A balance of $1,500. Okay. When calculating gain or loss, don't forget to update the accumulated depreciation account. In this example, before recording depreciation, the accumulated depreciation account was $8,000. $500 of additional depreciation was recorded at disposal, bringing the total accumulated appreciation to $8,500. The account loss on disposal, that's the account that is being used in this example. Now, this account has a normal debit balance, and it is recorded in the other income or expenses section of the income statement, which includes gains and losses on the sale of plant assets. So here you see accumulated depreciation equipment, $8,500 debit, loss on disposal, $1,500, and there's a credit to equipment for $10,000. Selling a plant asset at book value. On July 1st, the company sells equipment with a historical cost of $10,000 and accumulated depreciation. As of December 31st of the previous year, there was $8,000. Annual depreciation is $1,000. The first step is to bring the depreciation up to date by debiting depreciation expense, okay, and crediting accumulated depreciation for the equipment of $500. Touch Learning sells the equipment for $1,500. When a business sells an asset for book value, there's no gain or loss recorded. Now, this is because the cash received is equal to the book value of the asset sold. So here you see the market value of asset received, $1,500, less the book value of the asset disposed of, $10,000 cost, and the accumulated depreciation, $8,500, balance of a total of $1,500. So there's no gain or loss that is recorded. The entry to record the sale contains no gain or loss because the asset was sold for book value. So here you see cash was debited for $1,500. Accumulated depreciation equipment was debited for $8,500, and equipment was credited for $10,000. They sold the equipment for cash. And here below, you see the T accounts for cash, equipment, and accumulated depreciation equipment. Now, if Smart Touch Learning sells the equipment for $4,000, the company will record a gain on sale of the equipment. Now, notice here that the cash received is more than the book value of the asset. Now, when a business sells an asset for more than its book value, of course, there's a gain. So the market value of the asset received was $4,000. Okay, so there is a gain of $2,500. The account gain on disposal is being used here. Okay, now this account has a normal credit balance, and it is reported in the other income or the expense section of the income statement. In recording the journal entry, Smart Touch Learning will remove the old equipment and accumulated depreciation from the books. That is step 2. Step 3, they will record a debit to cash for $4,000, okay? And then step 4, they will record a credit on gain, okay? So that's a credit of $2,500 to gain on disposal. So you see the accounting equation reads A equal L plus E, assets equal liability plus owner's equity. Now the asset has cash as increasing, equipment as decreasing, and accumulated depreciation equipment as decreasing. That's how it would show on using the accounting equation. So what if Smart Touch sells the equipment for $500? Okay. If they sold the equipment for $500, of course, it's going to be a loss. So the company will record a loss on the sale of the equipment. Now notice that the cash is less than the book value of the asset. So when a business sells an asset for less than its book value, the loss is recorded. So here you see the loss of $1,000 is recorded. In recording the journal entry, Smart Touch Learning will remove the old equipment and the accumulated depreciation from their books, which is step 2. And then they will record a debit to cash for $500. And then they will record a debit to loss on disposal. So here you see cash debited, accumulated depreciation is debited, then loss on disposal is debited for $1,000. And equipment is credited for $10,000. So in each disposal that you see here, the company has decreased net income over the life of the asset by recording depreciation expense each year prior to the disposal. Now, when the company records the disposal, the company will record a gain, a loss, or neither. Gains recorded at disposal increase net income, and losses recorded at disposal decrease net income. Over the life of the asset, the company records a net increase in net income equal to the net cost of the asset. The net cost of the asset is the amount paid for the asset when it was purchased, less the cash received at disposal. Notice in this case here that the net decrease in net income is equal to the net cost of the asset. We have, in effect, expensed the net cost of the asset over its life. Here in Exhibit F1010, it summarizes the journal entries for discarding and selling of plant assets. So you see the discarding of fully depreciated plant asset, discarding a plant asset that's not fully depreciated. Here, selling a plant asset at book value, selling a plant asset above book value, and here, selling a plant asset below book value. Now, this is the end of part 3. We discussed Learning Objective 10.3, Journalize entries for the disposal of plant assets. So please watch out for our next video where we will discuss Learning Objective number 4, which deals with account for natural resources.
Thank you for watching. And please, if you haven't already, please click the subscribe button below.